Hey everyone, me Kevin here. Snowflake just filed an updated S1. That means basically they're planning on increasing the price of their IPO tomorrow. Their IPO tomorrow was supposed to start out at a price of $75 and $85, and we know that Warren Buffett and Mark Benioff of Salesforce have each invested over $250 million into this company, or maybe exactly $250 million into this company pre-IPO. And folks, this is probably going to be one of the hottest expected IPOs of, well, at least this week. But anyway, why would they raise their price? They were expecting to IPO for between $75 to $85, and now it's going to be between $100 and $110 per share, which sounds like it's a bad thing because, well, the share price is now going to be much more expensive out of the gate. But is it really a bad thing? Well, in this video, I'm going to break down three things. Number one, I'm going to break down whether or not that this price raise is actually good or is it bad. And then I'm going to talk about my updated thoughts on the company. I've been doing a lot more talking with many of you, especially in the Discord chat, in the comments. Yeah, there's so much going on this company. A lot going on with this one. And number three, we'll play around with some more and new price projections. In the meantime, just remember you can always get one free stock worth up to $1,600 if you deposit $100 with the stock trading platform Webull via the link down below. And of course, get your life insurance in as little as 5 minutes. First, Snowflake raising their IPO seems bad because it makes the stock more expensive on IPO day. But the reality is, no one was really expecting to buy the thing for between $75 to $85 a share anyway. And that's because usually in the first few minutes to the first few hours of trading on an IPO, there's so much buyer demand that comes in and few people choosing to sell that the price basically goes meteoric. It's not uncommon to see the price jump up 20 to 40% on IPO day and then find some sort of equilibrium later on, which could be that high, it could be higher, it could be lower. Nobody really knows what the market is going to do. But what we do know is a lot of people want to buy this stock, like ASAP. And on Saturday, I posted a breakdown of Snowflake's IPO, and I said that about 90 days after they file their prospectus, which you wonder which amendment that refers to, but roughly around the first to second week of December, there are going to be at about an additional 11 million shares that unlock for this software as a service or SaaS company. Meaning that instead of having 28 to 32 million shares on the market, there could be as many as 43 million shares on the market. And look, if the price shoots up after IPO and all of a sudden another 11 million shares hit the market, it's not uncommon to see the price pull back a bit. But 11 million shares, that's not even the real big problem. The big problem actually comes, I've got to read this paragraph here, okay? I got to read it and then I'm going to simplify it. Okay, here we go. The second trading day immediately following the day, the closing price of our common stock exceeds 133% of the IPO price as set forth on the cover page, blah, 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 for at least 10 trading days in the 15 trading day period following the 19th day after this prospectus. What the like, who writes this garbage? Here's basically what they mean. If between the first week of December and about the second week of December, the next 10 to 15 day period after that, the stock is trading for more than about $146. See, all I did there was take 110. Here, let's do it together. 110 times 1.33 is $146.30. If the stock trades for more than $146.30, assuming it IPOs for 110, otherwise just adjust it, then an additional, and this is the kicker, an additional 37.9 million shares will possibly be available to go onto the market. That means people who currently own up to 37.9 million shares would have the option of selling at prices that are 33% higher than IPO price. As soon as that happens, boom, they could all dump if they wanted to. And that's literally now doubling the amount of shares on the market. So all of a sudden, within 90 days, you go from 28 to 32 million shares, somewhere around there, to 43 million shares. And then potentially 2 weeks after that, you get double whammied and potentially we could see literally the outstanding share count for the public float, they call it, almost double. Like that's, like, I don't care what stock you are or how much hope you've got. Just they could be a problem, okay? Like, they could be a buying opportunity is all I'm suggesting. And especially since Warren Buffett and Mark Benioff already bought into these shares, they're not worried about the price going up and potentially coming down again. The last thing I want to do is put a Robinhood buy order in, and this is just my opinion, and then have it execute for like $150 only to see it go down substantially come late November and, probably before the end of the year. And who knows? Nobody knows. I mean, this could literally run up to $200, $250, right? And then we get the share dilution. People take profits. Boom, it comes back to $150. It'll still be way higher than where it was on IPO day. So maybe it won't matter, right? But these dates are really important to pay attention to, because if you are going to buy and hold this company, don't panic when those dates come. Just, I told you so. And, if it doesn't fall because people don't decide to sell, then, well, great, perfect, cool. Then that's a non-issue. So let's just move on from that. But I did want to say that the IPO price going up is actually a good thing because it increases that price where those 37.9 million shares unlock. If they did 75, they'd probably skyrocket past, whatever 75 is times 33% growth. Let's see, 75 times 33% growth would be somewhere around $99. They're going to fly past that. So that would almost guarantee the dilution right away, where this might be more where the underwriters are thinking, okay, maybe we'll balance around $120 a share or something like that. Wouldn't be surprised if kind of what they're thinking, and they're like, okay, only if the company does really well over the next few months, or those next shares going to dilute the rest of the float. We'll see. Okay, but for now, let's go ahead and get into some updated thoughts that I have on the stock. First, we know this is a SaaS company, software as a service company. And, that's great, because the nice thing about SaaS companies is when you spend marketing dollars, you're really just buying future income. And that sounds like, well, isn't that the point of marketing? Well, not really. See, when you advertise, let's say for Toyotas, and you spend $1 million advertising or running ads for Toyotas, maybe you create $2 million worth of revenue. Great, you created $2 million of revenue, and maybe you'll see a little bit of trickle in of future income. But people just bought the car and it's done, right? Well, with Snowflake, it's different. You spend $2 million, or let's say, go same number, you spend $1 million on advertising. Once you have those companies or customers locked in and they're paying you $1 million, well, next year, based on their previous growth metrics, they're not paying you $1 million anymore. They're also paying you more. They're now paying you $1.5 million. So all of a sudden, it's like in 2020, let's just say, to make it simple, you spend, here, you know what? We'll get the broken whiteboard out because it's fascinating, and it's a very different model than your sort of traditional advertising model, and understanding this difference, I think, is really important. It also makes valuing the company much more difficult, but let's be real, valuing any company, trying to determine what the stock market's gonna do is just a crapshoot. But trying to have some fundamental understanding is sometimes makes us feel better. Okay, so a company sells $1 million. Toyota sells $1 million worth of advertising, and then they get $2 million worth of cars, right? So they net $1 million was their net from that advertising. Well, next year, let's say Toyota puts their advertising at 0. So we'll put a T up here, okay? So Toyota puts their advertising at 0. Those $2 million in sales in the prior year, what are they gonna create? Maybe, I don't know, $100,000 in servicings, right? So their residual income is very, very, very low in the next year. They have to keep advertising. The cool thing about a software as a services company is as long as the company doesn't start sucking, they keep their prior year customer. So let's say, Snowflake does $1 million in marketing spend, and that generates $1 million worth of revenue, 1-for-1, which is kind of probably where they are now. They're getting better, they're maybe at like 1.3 now, but wanted to command undo that, but I guess I can't do that in real life. There we go, I had to do that. Anyway, this, let's say, is 2020, just as a rough example here. Let's go to 2021, and let's say they spend $0 on marketing. The crazy thing about this company is, based on their retention growth, they would generate somewhere around $1.57 million in revenue with no spending because of this original spending, because this base keeps going up. They have this consumption-based model where the more you use it, the more you pay, which initially I'm like, well, I mean, that makes sense. Isn't that with any service? But what makes this so extreme at this company is the fact that you've got massive corporations, Fortune 500 companies like Apple and Nike going, well, we're going to specifically hire Snowflake engineers to work on doing Snowflake stuff, coming up with data conclusions and marketing and business conclusions. I honestly, I don't 100% understand. I still don't 100% understand what this company does. I thought I had a really good example attempted explanation on Saturday, so I'll let you explore that one if you want. But I'm assuming at this point, if you're watching this second follow-up video, you probably have at least some understanding of Snowflake yourself. Go watch the other video if you want my rudimentary explanation. Look, if you show me a 2x4 and a nail, I will call a guy who can install it for you. Trying to explain Snowflake is not what I'm going to try to do again. But in the meantime, looking at it from a business POV, I like this. And, I understand the growth purchasing that they're doing with their marketing. Valuing this, though, very, very difficult. We will try. In fact, that's one of the reasons I love Lemonade so much is, well, Lemonade does a similar thing, but I would say Snowflake probably does it even better, and I think I just broke the whiteboard even more. Anyway, let's hit some risk factors quickly and take a sip of Topo Chico, and then let's look at some numbers. Okay, so risk factors. Number one, well, if you're gonna invest in this company, you probably wanna be comfortable that they're not gonna go bankrupt. So I personally recommend if you're going to invest in this company that at least you have some kind of connection to this space. So if you start hearing like other techies in whatever world you're in going, dude, Snowflake's starting to suck, at least you have a way to get out. Like you got a little red flag up front, like, oh, the latest Snowflake update, that one sucks. Man, I hate that they came out with Snowflake Service Pack 2. This sucks. I'm getting the blue snowflake of death. And I'm serious by that because that's why I love investing in companies that I use. When Tesla updates, usually I'm like, wow, that was annoying, and they now fixed that. I'm impressed. Well, when Microsoft updates, I usually think the opposite. So keep those things in mind. Anyway, same is true about Snowflake, so you want to keep that in mind. Number two, Amazon, we got to make sure that Amazon doesn't kill Snowflake. This is probably a bigger risk. See, Snowflake currently stores their data at Amazon's S3 servers, but Snowflake also directly competes with Amazon against Amazon's Redshift platform. So this is kind of weird. Like, it makes you wonder, like, would it even be legal for Amazon in this, like, devilish, monopolistic way to say, Snowflake's S3 servers, oops, delete. I don't expect that to happen, but I wouldn't be surprised if some tension comes from that. Okay, then, the big players right now in these sort of analytic softwares are Google's BigQuery, Redshift, and Snowflake. So we got to keep an eye on to see, is Snowflake going to continue to be able to innovate above these others? Number C, or I guess that's letter C, if there's any kind of security breach that ends up at Snowflake, I think that would impact Snowflake a lot harder than it would impact an Amazon or a Google. Especially since it's a startup. So it's something to keep in mind that, they promise they have better security, but look, every company that gets hacked says before they get hacked that they've got great security. And that's just being jaded. It just is what it is. It is what it is. Yeah, it is jaded. Letter D, we have to assume that their marketing costs are going to plummet as a percentage of their share of revenue, specifically because of what we learned on this whiteboard here. So my recommendation is to track their percentage of advertising compared to their revenue growth. Now, I'm going to go ahead and pull up a spreadsheet here. By the way, I do link my spreadsheets in my money and investing course. And if you're wanting to get started in learning how to invest in real estate, I've got another really amazing program. It's my most popular one. It's Getting Started Investing in Real Estate. So even if you're thinking about just buying a home for yourself, take that, because you're going to learn how to make money buying that first house rather than blowing your money. Anyway, there's still an old coupon code down there you're welcome to use. Okay, let's go ahead and pull up numbers here. Yes, Apple numbers. And let's try to do some playing around with the figurings here. And I'll show you how easily we can play with this, but also how dramatic the differences are when we do just that. So here's the thing. We'll pull up the spreadsheet here. Everything on the left is pretty much stuff we've already talked about in Saturday's video. So I'm not going to break this all down again. What I really want to do is play with these three scenarios that we've got here. So I'm doing red as sort of a bear case scenario, yellow as maybe a base case scenario, and green as more of a bullish scenario. So AKA green, I think it's doing better, red, I think it's doing worse, and yellow, I think it's doing okay. So in the red scenario here, if we get revenue growing by about 60% over the next 2 years, and we get their advertising costs down to 35%, it wouldn't be unreasonable to see this share price, be at least $73. Now, I realize that's below IPO price, and it really goes to show that there's a lot of growth built into this. Keep in mind, I've also reduced their research and development and their general administration costs to only about 10% of revenue. And because I am using their quarterly data ending July 31st, you're going to see a little note here that I wrote in double to annualize. So basically, the EPS is doubled to make it an annual figure. If you didn't understand that part, don't worry about it. Okay, so it may be a more base case scenario, and this is kind of what I expect, a little closer, if I dare even say that. I think the market's probably anticipating a little bit more of like slightly more than doubling every year in terms of growth, maybe like 120% growth per year, which would be like increasing by 220%, right? I get comments on the percentages every time. 120% growth. 120% growth for 2 years. So that's compounding for 2 years based on the quarter ending here in July of 2020. Then I also have their marketing at 35%. I kept all the other numbers the same. That would put them at somewhere with a P ratio of 100, which I realize is also very high, but that's about what these tech companies trade for, especially while they're still in their growth phase. I mean, Amazon still trades like this just because they have so little profit as a percentage of potential future income. And then maybe in the more bullish case scenario, we see this company growing by 180% per year. I think that's probably a little extreme, but that could push the stock over about $200 a share. I don't know that this is gonna, if this ends up turning into like a Zoom where it just goes to like $400 or something like that, I'll be shocked, but I'll tell you what it's gonna take to make this company turn into a Zoom, okay? So let's go in here and turn on the edit. Here's all we have to do. Let's go with the base case scenario here, this 120% growth for 2 years. And then all I'm gonna do is I'm going to drop the marketing percentage, which ending July 31st was about 78%. Before that, it was about 100%. So going down to 35% is already expecting their marketing budget as a percentage of revenue to really come down. But let's go ahead and say this comes down to, let's see here. The base case right now we've got at $132 a share. If I drop this to 34%, just 1% down, the share price goes up about $9. So literally, that is, in my opinion, one of the most important metrics, out of this entire company's investment is how much they're actually having to spend on marketing to continue to get this growth. Every single percent is huge. Every single 1% of marketing dollars, 1% of marketing total dollars that they spend in change, we get a share price change of what is that, 7 or 8%? That's big. If I drop this to 30%, it's just gonna be ridiculous. Watch, I drop it to 30%, it goes up to $174 a share. So all of these little changes, huge, huge, huge difference. If I go to 78% where they are now on the base case scenario with their growth, this is a money-losing company still. But I don't expect that because I'm doing percentage of revenue here. And again, using a little whiteboard model over here, I really think they're gonna get this under 50%. Let's go to 45%. At 45%, this is a $48 stock with a 100 PE ratio. But honestly, if they're still at 45% going to marketing dollars, they're gonna be trading for 500 times earnings, or 250 times earnings or whatever. 35%, a little bit more realistic. If we could get this company in the future in 2024 or whatever, which I really shouldn't be manipulating the 2022 data to do 2024, but if we could get them down to 25%, you know, it wouldn't be unreasonable to see this company trade for over $200 a share. And that is still building in a lot of future growth. And that's why we're going with that 100 PE ratio. So how can you really get hurt on this stock? Well, I think there are two big ways that you could get hurt on this stock, and then I'm going to tell you what I'm going to do. Number one way you could get hurt on this stock is you buy in too high on IPO day, which is Tuesday, September 15th. Which is also Apple Day. Well, not Apple like earnings day. It's just they're doing their non-iPhone event. Their headphone event. Headphone and watch event. Okay, fair, fine. Okay, so how can you get hurt? You buy in too high, and when it goes down, and when you see the boat rock because of dilution coming, you sell out. I think that would be a mistake. Obviously, it would be wise to sell out if this company misses its growth, or its growth to marketing spend starts like wedging. Basically, they have to spend more marketing dollars to get the same amount of growth. We want to see them spending less marketing dollars and having more growth as all their existing customers, again, going back to the whiteboard here, start spending more with the company. So, what am I going to do? Well, I think probably with my updated thesis here, I'll probably for giggles buy a little bit of the IPO stock on Robinhood tomorrow. I don't know exactly what time, but I'll just, you know, well, sometimes these things don't even show up on Robinhood or Webull or whatever. Sometimes you have to go into TD Ameritrade or Fidelity or whatever to execute on these, which I might do. I don't think I'll put in a lot. I would say I'd probably put in I don't know, like less than half of 1% of the cash that I have available. So a small amount. Then if the stock starts pulling back in November and December, I think that's where I'm going to be more interested. But in the meantime, what I might do is once this stabilizes next week, I might be interested in adding this to my 1337 pie. Many of you already know I have that pie. It's in the link down below with M1 Finance. metkevin.com/1337V9 or V10, one of those versions. You'll see it in the description. You can always just try changing the end of the URL to find the most recent version we're on. But those are my favorite stocks right now with their allocations. I could see myself including Snowflake right there at NVIDIA and AMD levels, around 2 to 3% in the portfolio in the long run. I'm not convinced that I want to buy in right out of the gate on IPO, but I do think as long as this company maintains its ability to pull this whiteboard here, this is a good growth company. I like it. I like what I've seen, and the support it has gotten from the community is out of this world. The amount of you who Instagram DM'd me about this, insane. And you know, part of that could be just hype, or part of it could be, holy crap, you're at your job and you're like, oh my gosh, yeah, no, this is good. Yeah. Anyway, if you like this kind of content, make sure to share it, make sure to subscribe. Really appreciate you watching this, and folks, we will see you next time.